Hi everyone, welcome to TYG Trading. I'm coming back to continue a topic about liquidity provider. From now on, we don't talk about unregulated brokers. Using unregulated brokers is highly possible they are scammers, but not always. And nobody will know this for sure. So, when we want to jump into CFD, the first priority is we look for a regulated broker. Talking about liquidity provider, it is very tiring to discuss since many have assumed brokers are cheating on us. Let us set aside this issue. Let us talk about what is liquidity provider, or in short is an LP. In the previous episode, I had explained that broker will send our transaction to the market. Borrowing from the broker's point of view, the market is the LP. So LP is where our transaction will be going to. In real form, LP can be a bigger brokers, financial institutions, or financial infrastructure company. The last two are commonly addressed as the market. There are brokers who can make a direct connection to the market, while others have to connect via alternative ways such as bigger brokers. All of this happen because of regulation. Regulation is an independent institution or a government-backed institution that will supervise and monitor the operation of broker and or relate to them. Without regulation, we don't know how a broker will manage their operations. We don't talk too much about the regulation for now. When there is a chance, I will talk more in the next time. So, one of the purpose of a regulator is to design how the CFD market is operated. That include the capital requirement for a broker and also for liquidity providers. There are many scenarios for each party that participate in this industry. Each scenario will affect each of them with their own policy. As long as they are under the guidance of the regulator, they are legal to run the business. For example, when regulators define the market to have capital at least $1 million, every broker that has at least $1 million will have a green light to run their business. The regulator also make a policy to the market that says the regulator requires them to have capital at least $10 million. So whoever owns this amount of money can act as the market. Fair enough? By having this requirement, the market will be very selective to find who can connect to them. It is all about the cost of operation and making profit to run the business. This is why then there are brokers that have direct connection to the market while others have to find alternative to run their business. Let me give another example. There are liquidity providers who require brokers to have 5 million at least in order to connect to their network. When there are two brokers, let's say broker A and broker B, broker A has $5 million for its capital while broker B only has $1 million US. Both of them are valid under the regulator because regulator only need them to have $1 million US as capital. Since broker A has enough capital by the liquidity provider, broker A will be able to connect to the market by the LP. How about broker B? It is a valid broker, but they are lack of capital according to the LP. Broker B can ask broker A as the mediator to connect to the market. In this scenario, broker A has a direct connection to the market. Broker B has also a connection to the market via broker A. We can say the LP for the broker A is the market. As for broker B, their LP is broker A. Both of them are recognized as STP broker equally. By this example, we now have a clear definition about what an LP is. There are a lot of things about LP such as Tier 1 and Tier 2 LP. I limit the discussion until here since I'm not trying to describe LP in detail. So, LP is just where our order is being sent based on the broker point of view, nothing more. The next question, when a broker can be an LP for others, meaning our order will be delivered from small broker to big brokers. Where will all the orders end? The answer is on the hand of market maker. They are also known as the Tier 1 liquidity provider. The center of all CFD's order are being executed. So, what is market maker? Market maker are mostly big banks and big financial institutions. The destination of our orders will be them. Can we assume our profit will be their losses and our losses will be their profit? Is CFD a zero-sum game against them? It is completely wrong. To answer these questions, we have to look into the details of how brokers send our orders to them. What are the details of processes? The following explanation will only be valid to a real broker. When we insist CFD is a fake trading, that will apply to most non-regulated brokers. In short, all transactions will be sent to Liquidity, which are finally ended on banks and financial institutions. Both of them are the same. They buy and sell currencies. It is a very old-fashioned transaction. Let me simplify how they work. When we want to trade currency from bank, we need to open multiple currency accounts. If we want to trade euro, pound sterling, and US dollar, we need at least 3 different accounts in the bank. Assuming our base currency is US dollar, so we put our deposit in our USD account, then we can start to trade immediately. Assuming our base currency is US dollar, so we put our deposit on our USD account, then we can start to trade with the bank. Let's say we deposit 50,000 US dollar as our initial trading capital. The money will be kept in our USD account. Later, we buy euro 10,000 for 1.2 US dollar. Our USD account will be deducted 12,000 US dollar and 10,000 euro will be added in our euro account. In CFD, what we do is buying euro USD. Next, we also buy 10,000 pound sterling for 1.3 US dollar. Again, our US dollar account will be deducted $13,000 and our pound sterling account will be added 10,000. In CFD, we are buying GBP USD. This information is provided by MT4 or MT5 at the toolbox panels under the Exposure tab. Later, euro is up 1.3 US dollar each. Feeling enough, we sell our euro back to US dollar. 13,000 US dollar will be added back to our USD account after 10,000 euro has been deducted from our euro account. In CFD, what we do is sell euro USD. Finally, GBP is also up to 1.5 US dollar. After we sell it, the final profit from our transactions will be $8,000. There are many old generation traders still trading forex in this way. They will contact the bank trading from the counter. This is the reason why CFD is then called as an OTC product over the counter. Since every bank can provide these services, the market is not centralized. When it is not centralized, there will be opportunities for the banks to provide the service unfairly. When there is no broker, this is the real form of forex trading. Bank will buy and sell based on the latest rate. Bank will profit by marking up the price or charging us commissions. I will limit my discussion about bank up to here. I don't want to talk more about how they make money from buying high and selling low to their customer. In short, the secret of their profit is in performing hedging. It is the most important activity and reason why they can keep profiting while we think they are losing. Without a broker, trading forex will be difficult. So, brokers see these opportunities and CFD was introduced from here. And these are what happened to all our transactions. So, can we still say brokers are trading against us? Can we still say our profit is their loss and vice versa? Next, I will talk about the process during a transaction between broker and LP. From here, we can see very clean why CFD is not a zero-sum game. Many say broker profit are our losses. For regulated brokers, it is completely wrong, a baseless assumption, or wild accusation because we don't understand how CFD works. If you enjoy my contents, feel free to subscribe and a like will be very much appreciated as well. You may also leave questions in the comment section. I will try my best to answer honestly.